time. The evening star pattern is more than just a visual cue on a chart. It's a powerful and reliable indicator that can signal a significant shift in market sentiment. Understanding how to recognize and trade the evening star effectively can provide a substantial edge in your trading strategy. This pattern is particularly valuable because it often appears at the top of an uptrend, acting as an early warning that the market's bullish momentum is fading and a potential downtrend is on the horizon. When you identify an evening star pattern, you're essentially seeing a three-part story unfold on the chart. The first candle in the pattern is a strong bullish candle, which reflects the ongoing strength of the uptrend. This is followed by a smaller bodied candle, which shows that the upward momentum is beginning to stall. This candle might be bullish, bearish, or even a doji, but the key point is that it signifies indecision among market participants. Finally, the third candle in the pattern is a large bearish candle that closes well into the body of the first candle, confirming that sellers have taken control and that a reversal is likely underway. Trading the evening star effectively means understanding not just the pattern itself, but also the context in which it appears. For instance, the reliability of the evening star increases when it forms after a prolonged uptrend, particularly if the preceding trend has been steep. This context suggests that the market may be overextended, making it ripe for a reversal. Additionally, the strength of the third bearish candle is crucial if it closes decisively below the midpoint of the first candle. It reinforces the signal that the buyers are losing their grip. By spotting the evening star early, you can position yourself ahead of the curve, entering a short position or exiting a long position before the broader market catches on. This proactive approach allows you to capture gains from the very start of the new downtrend rather than reacting after the reversal has already begun. Moreover, when combined with other technical tools such as volume analysis, support and resistance levels, or complementary indicators like the Relative Strength Index RSI, the evening star can form the cornerstone of a well-rounded, effective trading strategy. Ultimately, mastering the evening star pattern equips you with the ability to anticipate market reversals with greater accuracy, enhancing your ability to manage risk and maximize returns. It's a pattern that not only helps you avoid the pitfalls of holding onto positions too long, but also enables you to capitalize on new opportunities as the market shifts direction. By integrating this pattern into your trading strategy, you align yourself with the market's natural rhythms, positioning yourself for success in both trending and reversing markets. Imagine you're analyzing a chart and notice a strong upward movement, followed by a small-bodied candle that indicates indecision in the market. The final piece of the puzzle is a large bearish candle that closes well into the body of the first candle, completing the evening star pattern. This setup is your cue that the upward momentum is losing steam and a reversal might be on the horizon. Once you've identified the evening star, the next step is setting up your trade. One effective approach is to place your stop loss just above the high of the small-bodied candle. This level acts as a safeguard, protecting you if the market doesn't reverse as anticipated. You'll want to enter your trade as the bearish candle closes, confirming the pattern. This timing helps you capitalize on the emerging downtrend while keeping your risk in check. To execute this strategy, it's essential to use the right order types. A stop limit order can be particularly useful here. By setting a stop price slightly below the close of the bearish candle and a limit price at a level that ensures you enter the trade at a favorable point, you can manage your entry with precision. This approach allows you to control your exposure and optimize your potential returns. Trading the evening star pattern isn't just about spotting the right setup, it's about executing your trades with precision and confidence. By combining this pattern with thoughtful order placement, you can anticipate market reversals more effectively and take your trading strategy to the next level. The evening star pattern is made up of 3 distinct candlesticks that work together to signal a potential bearish reversal. The first candle is a large bullish one, reflecting strong upward momentum. This is followed by a small-bodied candle, which can be either bullish or bearish, showing a pause or indecision in the market. Finally, a large bearish candle completes the pattern, indicating that the sellers have taken control and a downtrend may be about to begin. This pattern typically forms at the peak of an uptrend, acting as a warning that the current upward movement is losing steam and a reversal could be imminent. The transition from bullish to bearish sentiment is key here. After the evening star forms, the likelihood of a downward shift increases significantly. To truly grasp the power of the evening star, it's helpful to consider real-world examples where this pattern has signaled a shift in market direction. By analyzing these examples, you can see how the pattern unfolds and how it can provide early indications of a market reversal. Understanding this pattern in action equips you to better anticipate market moves and adjust your trading strategy accordingly. When you identify the evening star pattern, knowing how to set up your trades is essential for making the most of this signal. First, focus on your entry point. You should enter a short position immediately after the bearish candle confirms the pattern. This is when the market has shown clear signs of shifting from an uptrend to a potential downtrend. To manage your risk effectively, always set a stop loss. Ideally, place this stop loss just above the high of the evening star pattern. For example, if you enter the trade at $100 and the high of the pattern is at $105, you would set your stop loss slightly above that, perhaps at $106. This placement helps protect your position in case the market doesn't follow through with the expected reversal. By carefully planning your entry point and setting a well-placed stop loss, you can significantly enhance your trading of the evening star pattern. Thoughtful entry point selection allows you to capitalize on the precise moment when the market begins to show signs of a reversal, ensuring that you enter the trade with the best possible advantage. This approach not only maximizes your potential for profit, but also reduces the risk of entering prematurely or missing the optimal entry. Setting a well-placed stop loss is equally important. It acts as a safety net, protecting your capital by automatically exiting the trade if the market moves against you beyond a certain point. For the evening star pattern, placing your stop loss just above the high of the pattern ensures that you're limiting your exposure to risk. If the market fails to reverse as expected, this strategy helps you avoid significant losses and preserves your ability to re-enter the market under more favorable conditions. Together, these strategies carefully timing your entry and strategically placing your stop loss allow you to trade the evening star pattern with greater confidence. You're not only safeguarding your investments, but also positioning yourself to take full advantage of the market's potential shift. This disciplined approach to trading helps you stay focused on your strategy, minimizing emotional decision-making and improving your overall trading performance. A stop-loss market order is an essential tool for any trader, providing a safeguard by automatically selling your position when the market reaches a specified price. This is particularly valuable in volatile markets, where prices can change rapidly and unpredictably. By using a stop loss, you create a safety net that helps protect your investments from significant downturns, ensuring that you don't hold onto a losing position longer than necessary. Setting up a stop-loss order in RTrader Pro is a straightforward process that adds a crucial layer of risk management to your trading strategy. Here's how to do it. First, start by selecting the position you want to protect. This could be any stock, future, or asset in your portfolio that you're currently holding. Once you've selected the position, navigate to the order options within the RTrader Pro platform. Look for the Stop Loss Order option and select it. The next step is to determine your trigger price. This is the specific price level at which you want the stop loss to be activated. It's important to choose this price carefully, as it represents the point at which you're willing to exit the trade to prevent further losses. Ideally, your trigger price should be set just below a key support level if you're holding a long position, or just above a resistance level if you're shorting. After entering your trigger price, take a moment to review the details and ensure everything is correct. Once you're satisfied, confirm the order. With the stop-loss order in place, your position will be automatically sold if the market price reaches the trigger level you've set. This automatic action helps to limit your losses, allowing you to manage your risk more effectively without having to constantly monitor the market. By incorporating stop-loss orders into your trading strategy, you not only protect your positions, but also reduce the emotional stress of trading. Knowing that your downside is covered allows you to focus more on identifying new opportunities and less on the potential risks. This proactive approach to risk management is key to long-term success in trading, helping you to navigate even the most volatile market conditions with greater confidence. Let's explore the differences and applications of market limit and stop limit orders, both of which offer distinct advantages in executing trades. A market limit order is designed to execute a trade at a specific price or better. This ensures that you achieve your desired entry or exit price. However, while a market limit order guarantees the price you want, it doesn't guarantee that your order will be executed if the market doesn't reach your specified price. For example, if a stock is trading at $50 and you want to buy it at $49, you would set a market limit order. If the price drops to $49 or lower, your order will execute at that price or better. On the other hand, stop limit orders combine the features of stop orders and limit orders, giving you more control over the execution. With a stop limit order, the trade is triggered when the stock reaches a specific price, known as the stop price. Once triggered, the order becomes a limit order, which will only execute within a set price range. This allows you to manage slippage during volatile market conditions by ensuring the trade only happens within your predetermined range. For instance, if you want to sell a stock if it falls to $48, you can set a stop limit order with a trigger at $48 and a limit at $47, ensuring your trade executes within that range. While market limit orders focus on securing the best price, stop limit orders offer the flexibility of execution within a specific price range, giving you greater precision and control over your trades. When trading the evening star pattern, there are several practical tips to keep in mind that can enhance your strategy. First, always confirm the pattern with volume. The validity of the evening star pattern is strengthened when the bearish candle forms with higher volume, indicating strong selling pressure. This volume confirmation helps ensure that the pattern is not just a random occurrence, but a genuine signal of a potential reversal. Second, consider using additional indicators to boost the accuracy of your trades. Combining the evening star with indicators like the relative strength, index, RSI, or moving averages can provide additional layers of confirmation. For example, if the RSI is showing overbought conditions alongside the formation of an evening star, the likelihood of a successful reversal increases. Managing risk is a fundamental aspect of successful trading, and using stop-loss orders is one of the most effective ways to protect your positions. When trading the evening star pattern, it's essential to set a stop-loss to guard against unexpected market movements. Specifically, placing your stop-loss just above the high of the evening star pattern is a strategic move that allows you to limit potential losses if the market doesn't reverse as anticipated. This approach is particularly effective because the high of the evening star pattern represents a critical resistance level. If the market were to move back above this point, it could indicate that the reversal signal from the evening star is failing, and the upward trend might continue. By setting your stop-loss just above this high, you ensure that your exposure to further losses is minimized, allowing you to exit the trade with a controlled and acceptable level of risk. This protective measure enables you to confidently participate in the trade, knowing that your downside is limited while still allowing you to capitalize on the potential bearish reversal the pattern suggests. Beyond immediate trade management, it's also invaluable to invest time in reviewing historical patterns. Studying how the evening star has played out on past charts can significantly enhance your understanding of its reliability and effectiveness. This historical analysis involves looking at various market conditions where the evening star appeared and evaluating the outcomes. Did the pattern consistently lead to a reversal? Were there instances where the reversal was stronger or weaker, and what market conditions contributed to these differences? By analyzing these past occurrences, you can start to identify the nuances that might affect the performance of the evening star in your current trades. For example, you might notice that the pattern tends to be more reliable when it occurs after a prolonged uptrend or when confirmed by other technical indicators like moving averages or volume spikes. Understanding these nuances allows you to refine your trading strategy, improving your ability to make informed decisions based on the specific context in which the evening star appears. Incorporating these insights into your trading not only enhances your approach to managing risk, but also improves your overall strategy. It allows you to differentiate between high probability setups and those that might warrant more caution. By combining disciplined risk management with a deep understanding of historical patterns, you can approach trading the evening star with greater confidence, precision, and a higher likelihood of success. Now, let's delve into the tools and platforms that can enhance your chart pattern analysis. RTrader Pro is an excellent choice, offering advanced charting tools and real-time data that are ideal for identifying key patterns like the evening star. To set a stop loss in RTrader Pro, start by selecting the position you want to protect. Navigate to the order options, choose stop loss, and then enter your trigger price. This feature helps you manage risk by automatically selling your position if the market moves against you. For market limit orders, the process is just as straightforward. Select Limit Order from the options, input your desired price, and then execute the order. This ensures that your trade will only be executed at your specified price or better, giving you control over your entry or exit points. If you're looking to use stop limit orders, RTrader Pro makes this easy as well. Begin by selecting Stop Limit from the order options. Enter both the trigger price, where the order becomes active, and the limit price, which sets the range for execution. After confirming these details, your stop limit order is set, allowing you to control the execution of your trade within a specific price range. Using our Trader Pro's robust tools, you can efficiently manage your trades, protect your positions, and leverage advanced chart analysis to identify and act on patterns like the evening star with precision. As we conclude, let's recap some key tips and best practices to strengthen your trading approach. We've explored how to identify the evening star pattern, how to set up your trades, and how to effectively use key order types like stop loss, market limit, and stop limit orders. First, always confirm the evening star pattern with volume. Higher volume on the bearish candle adds validity to the pattern, indicating strong selling pressure and increasing the likelihood of a reversal. Second, don't rely solely on the pattern itself. Use additional indicators, such as the relative strength index or moving averages, to provide further confirmation and improve the accuracy of your trades. Risk management is critical, so make sure to use stop-loss orders to protect your positions. Setting your stop-loss just above the high of the evening star pattern can help minimize losses if the market doesn't move as expected. By incorporating these tips into your trading strategy, you can make more informed decisions and enhance your profitability. Use these techniques to build a solid foundation for your trading, allowing you to approach the market with greater confidence and precision. Thank you for joining us today. Keep learning, keep trading, and see you next time. The evening star pattern can be a powerful signal for predicting bearish market reversals, and today we'll dive deep into how you can trade it successfully. Imagine being able to spot the shift before the market turns downward, giving you the edge to protect your investments and even capitalize on the decline. That's what mastering the evening star can offer. First, let's talk about what makes the evening star so significant. This pattern typically appears after an uptrend, signaling that the bulls are losing their grip and the bears are starting to take over. You'll recognize it by a 3-candle formation, a large bullish candle followed by a small-bodied candle, and then a large bearish candle that closes below the midpoint of the first candle. This sequence is like a red flag, warning you that the trend might be about to reverse. Once you've identified the evening star, the next step is setting up your trades. Timing here is crucial. You don't want to jump in too early or too late. Wait for confirmation that the pattern is complete, usually by observing the close of the third candle. If the market closes below the midpoint of the first candle, that's your signal. Now, let's talk about executing the trade. You've got your confirmation, and it's time to place your orders. 2 key order types will be your best friends here, the stop loss and the market limit order. A stop loss is essential for protecting your capital. Place it just above the highest point of the evening star pattern to limit your risk if the trade doesn't go as planned. On the other hand, a market limit order allows you to enter the trade at a specific price level, giving you control over the entry point. Understanding and using the evening star pattern can significantly boost your trading strategy. It's not just about predicting a downturn, it's about doing so with precision and confidence, ensuring you're always a step ahead in the market. The evening star pattern is just as relevant in the futures market as it is in other markets. When trading futures, whether it's commodities like oil, gold, or agricultural products, or index futures such as the S&P 500, identifying this pattern can give you a significant edge in predicting bearish reversals and positioning yourself accordingly. Imagine you're watching the price action in crude oil futures. The market has been in a strong uptrend, perhaps driven by geopolitical tensions or supply constraints. You observe the first candle in the evening star pattern, a large bullish candle that reflects this ongoing upward momentum. Traders are confident, pushing prices higher as they anticipate further gains. But then something changes. The next session opens slightly higher, but the price action is muted, resulting in a small-bodied candle. This candle signifies that the bullish momentum is starting to wane. Traders are becoming cautious, perhaps due to new data suggesting increased production or a potential easing of the geopolitical situation. This second candle is the market's way of pausing as participants begin to reassess their positions. The crucial moment comes with the third candle, large bearish one. This candle opens lower and closes well below the midpoint of the first candle, signaling that sellers have taken control. Perhaps news has emerged that significantly changes the supply-demand outlook, or perhaps technical factors have triggered a sell-off. Whatever the reason, the bearish candle confirms that the uptrend is likely over, and a reversal is imminent. Traders who recognize this pattern can act swiftly, perhaps by shorting crude oil futures or adjusting their positions to protect against a downturn. Let's consider another example, this time with equity index futures like the emini S&P 500. The market has been in a bullish phase, driven by strong corporate earnings or favorable economic data. The first candle in the evening star pattern is a strong bullish one, reflecting the optimism in the market. But then, as the index futures open slightly higher the next day, the momentum begins to fade and we see a small-bodied candle. This candle suggests that market participants are starting to question whether the rally can continue, maybe due to concerns over inflation or a potential interest rate hike. Then the third candle appears, a large bearish candle that closes below the midpoint of the first candle. This signals a shift in sentiment as traders start to lock in profits or hedge against potential risks. The evening star pattern in this context is a warning sign that the bullish trend might be reversing, providing traders with the opportunity to take a defensive stance or even capitalize on the downturn by shorting the futures or using options strategies. In both of these futures markets, the evening star pattern serves as a powerful tool for traders. It's not just about recognizing the pattern, it's about understanding the underlying market dynamics that lead to its formation. Whether it's changes in supply and demand for commodities or shifts in investor sentiment in equity markets, the evening star gives you a heads up that the market's direction is likely about to change. By incorporating this pattern into your trading strategy, you can better anticipate market movements and make more informed decisions, whether you're trading crude oil, gold, or index futures. When you spot the evening star pattern, the next crucial step is setting up your trades with precision. Identifying the right entry point is key to maximizing the potential of this bearish reversal signal. Once the third candle confirms the pattern by closing bearish, that's your cue to consider entering a short position. This confirmation shows that sellers have taken control and the market is likely to move downward. Timing your entry is critical. You want to enter your short position soon after the third candle closes, but not before. Jumping in too early can expose you to the risk of a false signal, while waiting too long might mean missing out on the best price. Risk management is just as important as timing your entry. Always set a stop loss to protect your capital from unexpected market movements. The ideal spot for your stop loss is just above the high of the evening star pattern. This way, if the market moves against you and breaks above the pattern's high, your position will be closed automatically, limiting your losses. For example, let's say you identify the evening star pattern and decide to enter a short position at $100. Based on the pattern, you observe that the highest point, or the top of the first bullish candle, is around $105. To manage your risk effectively, you set your stop loss at $105. This setup ensures that if the market moves above this level, signaling that the bearish reversal might not hold, your position is closed, capping your potential loss at $5 per unit. By carefully selecting your entry point and setting a well-placed stop loss, you can trade the evening star pattern with greater confidence and control. This approach helps you not only capitalize on potential bearish reversals, but also protect your capital from adverse market movements, ensuring a balanced and strategic trading plan. A stop-loss market order is a vital tool for minimizing potential losses by automatically selling your position when the price reaches a predetermined level. This mechanism is particularly useful in protecting your investments from sudden market downturns, ensuring you exit a trade before the losses deepen. To set up a stop-loss order in RTrader Pro, follow these straightforward steps. First, navigate to your trading dashboard and select the stock or futures contract you want to protect with a stop loss. Once you've highlighted the asset, look for the Order Options menu and choose Stop Loss Order from the list. Next, you'll need to enter your trigger price. This is the price level at which you want the stop loss order to activate. For instance, if you've entered a trade at $100 and you want to limit your potential losses to $5 per unit, you would set your trigger price at $95. Once the market reaches this price, the stop loss market order is triggered, and your position is sold automatically at the next available market price. This process not only helps you manage your risks effectively, but also allows you to step away from the screen without worrying about missing critical price movements. By setting a stop loss, you ensure that your downside is protected, allowing you to trade with greater peace of mind and discipline. Understanding how to effectively use market limit and stop limit orders can significantly enhance your trading strategy by providing greater control over your trades. A market limit order is designed to execute a trade at a specific price or better. This type of order is particularly useful when you want to ensure that you get a specific entry or exit price, but it comes with a trade-off. While it guarantees the price, it doesn't guarantee that the trade will be executed. For example, if a stock is currently trading at $50 and you want to buy it at $49, you would place a market limit order at $49. If the stock reaches $49 or lower, your order will be executed at that price or better. However, if the stock never drops to $49, your order won't be filled, potentially missing the trade. On the other hand, a stop limit order offers a blend of the features found in stop orders and limit orders. This type of order sets both a trigger price, the stop, and a limit price, creating a range within which the trade will be executed. It provides more control by ensuring that the trade only occurs within the specified price range, but like market limit orders, it doesn't guarantee execution. For instance, imagine you own a stock currently trading at $50 and you're concerned about potential downside. You could set a stop limit order with a stop price of $48 and a limit price of $47. If the stock price drops to $48, your stop limit order is triggered, and the trade will be executed as long as the price stays within your specified range of $47 to $48. If the price falls below $47, the trade won't be executed, allowing you to avoid selling at a price lower than you're comfortable with. To summarize, while market limit orders guarantee that you will only buy or sell at a specific price or better, they don't ensure that your trade will be executed if the price never hits your limit. Stop limit orders, on the other hand, ensure that your trade is executed within a specific price range, but they also don't guarantee execution if the price moves beyond your defined range. These orders are powerful tools that, when used correctly, can help you navigate the complexities of the market with greater precision and control. When trading the evening star pattern, it's essential to follow a few practical tips to increase your chances of success. These strategies help confirm the pattern's validity and manage your risk more effectively, ensuring that you're trading with a higher level of confidence. First, always confirm the pattern with volume. The volume of trades during the formation of the evening star can provide crucial insights into the strength of the reversal. Specifically, pay close attention to the volume on the third bearish candle. If this candle forms with significantly higher volume than the preceding candles, it suggests strong selling pressure and adds credibility to the reversal signal. High volume indicates that more market participants are convinced of the downturn, making it more likely that the pattern will follow through. Next, enhance your analysis by using additional indicators. While the evening star pattern is a powerful signal on its own, combining it with other technical indicators can provide even more accuracy. For example, you might look at the relative strength index RSI to see if the asset is overbought, which would support the likelihood of a bearish reversal. Similarly, you can use indicators like the stochastic oscillator to gauge momentum, ensuring that the market is indeed losing steam before you commit to a trade. Risk management is crucial in any trading strategy, and the evening star pattern is no exception. Always use stop-loss orders to protect your positions. Set your stop-loss just above the high of the evening star pattern to limit potential losses if the market moves against you. This way, if the pattern fails and the market continues to rise, your stop-loss will automatically close your position, minimizing your downside risk. Finally, make it a habit to review historical patterns. Studying historical charts where the evening star pattern has appeared can give you a better understanding of how it tends to play out in different market conditions. By analyzing past instances, you can identify common outcomes, recognize the pattern's reliability in various contexts, and refine your trading approach based on what you've learned. This historical perspective not only enhances your strategy, but also builds your confidence in trading the evening star pattern. Incorporating these tips into your trading routine can help you better navigate the complexities of the market, making the evening star pattern an even more effective tool in your trading arsenal. To effectively analyze chart patterns like the evening star, leveraging the right tools and platforms is essential. RTrader Pro stands out as a powerful option, offering advanced charting tools and real-time data that make identifying and acting on these patterns more precise and efficient. RTrader Pro's charting capabilities allow you to visualize market movements in detail, making it easier to spot key patterns like the evening star. The platform provides various customization options, letting you adjust time frames, overlay technical indicators, and zoom in on specific periods to get a clear view of the price action. This level of detail is crucial for accurately identifying when the evening star pattern forms, giving you the confidence to act quickly. Once you've identified the evening star pattern and are ready to set up your trade, RTrader Pro also makes executing orders straightforward. For setting a stop loss, follow these steps. First, select the position you want to protect. Then, choose the stop loss option from the order types. Enter your stop loss price is typically set just above the highest point of the evening star pattern to limit potential losses. Once you've entered the price, confirm the order, and your stop loss is in place, ready to manage risk automatically. If you prefer to use a market limit order, our Trader Pro has you covered. To place a market limit order, select the asset you want to trade, then choose Limit Order from the order options. Input the price at which you want the order to execute. For example, if you're aiming to buy at a price lower than the current market price, enter that desired price. Confirm the order, and our Trader Pro will execute your trade only if the market reaches or betters your specified price, ensuring you get the entry or exit point you want. For more nuanced trading strategies, such as using stop limit orders, our Trader Pro also provides an easy-to-follow process. Start by selecting Stop Limit from the order types. You'll need to enter two prices, the stop price, which triggers the order, and the limit price, which defines the worst acceptable price for execution. For instance, if you want to sell a stock, if it drops to $48 but not lower than $47, set your stop price at $48 and your limit price at $47. After entering these details, confirm the order. This setup ensures your trade is executed within your specified range, offering both control and flexibility. Using our Trader Pro's tools and features, you can analyze patterns like the evening star with confidence and execute your trading strategies with precision. Whether you're setting a stop loss to manage risk, placing market limit orders to secure your desired price, or configuring stop limit orders to ensure trades occur within a specific range, our Trader Pro gives you the power to trade more effectively in a complex market environment. As we bring our discussion to a close, let's take a moment to recap the essential tips and best practices that can help you effectively trade the evening star pattern and improve your overall trading strategy. First, remember the importance of accurately identifying the evening star pattern. Recognizing the three-candle formation, large bullish candle, a small-bodied candle, and a large bearish candlete, the top of an uptrend, is the first step in predicting a potential bearish reversal. This identification is crucial as it sets the stage for the rest of your trading decisions. Once you've identified the pattern, setting up your trades becomes the next priority. We've discussed how to enter a short position after the bearish confirmation of the third candle. This timing is key to maximizing the potential of the reversal while minimizing the risk of a false signal. Don't forget to confirm the pattern with volume. Higher volume on the bearish candle strengthens the signal, indicating that the market is likely to follow through with the downward trend. Volume acts as a reinforcement, adding confidence to your decision to enter a trade. Using additional indicators alongside the evening star can further enhance your accuracy. Indicators like the Relative Strength Index (RSI) or the Stochastic Oscillator can help you gauge market conditions, ensuring that the pattern is supported by broader technical signals. Risk management is another critical aspect we've covered. Always use stop-loss orders to protect your positions. By setting a stop-loss just above the high of the evening star pattern, you can limit potential losses and safeguard your capital against unexpected market movements. Finally, continually refine your strategy by studying historical patterns. Reviewing how the evening star has played out in various market conditions can provide valuable insights, helping you to fine-tune your approach and make more informed trading decisions in the future. By applying these tips, confirming patterns with volume, using additional indicators, managing risk with stop-loss orders, and learning from historical data, you can significantly enhance your trading strategy and make more confident, well-informed decisions. These best practices will not only help you in trading the evening star pattern, but will also strengthen your overall approach to the markets. Thank you for joining us today. Keep learning, keep trading, and see you next